So I'm going to go through how risk really affects our investments and what types of risks and really how they affect the pricing of companies in specific. So as we pretty much all know, risk and return are related. High risk, high returns is the expectation. High risk, high reward is normally the saying. But most people will overlook or underestimate the importance of risk. Risk can really be broken down into two broad categories: systematic risk and unsystematic risk. Systematic risk is really derived just from participating in a certain market. So if you want to invest in, say, let's say a Japanese company, you're subject to the systematic risk of Japan. Makes sense. So this would be things like the Bank of Japan raising interest rates, which they haven't in a long time, which is why I'm specifically using this as an example, because there has been a bit of push not raising interest rates, but they've been lowering their bond buybacks recently. So it is something to watch. And that's obviously a systematic risk to Japan. Other types of systematic risk is, let's say, an earthquake. If an earthquake were to devastate Japan, no matter how much of a tragedy it would be, it's obviously a big effect on their economies. And really any industry or has a company that has exposure to Japan, in that case, would feel the negative impact of it. So that's really what systematic risk is. A real-world example of this is the Great Recession. The entire financial system in the US especially just froze up. There was no liquidity, which caused financial markets to fail, and effectively, through contagion and other methods, affected the entire world. That was a very big systematic risk. Even though it was more or less the US, initially it spread out throughout the world. And it was really the entire financial system there. So people will commonly call systematic risk as undiversifiable because you can't really get out of it if you want to invest in that market or that sector. You have to be exposed to that risk. It's not absolute, it is a bit fuzzy. So like if you're investing in, let's say, Japan, but like it's one operation there, and it's not like your entire sectors there. Let's say they're impacted by, so they make a lot of transistors. Let's say that would move to China, would move to Shenzhen. So there's risk, but it's not like it's always extremely strong. It can be less or more. And people try to quantify this through the number, the beta number. So you commonly see this quoted on like Yahoo or something like that. And it's not perfect, but it's a number really trying to put to it. And you'll commonly see this in any long-term analyst reports. If they're doing any discounting cash flows, they'll use beta as a starting point to estimate systematic risk. On the other hand, we have unsystematic risk. And this risk is really the risk that affects an individual firm. It's really what they do can affect it. So if you invest in a company that does one thing and one versus another one that doesn't, one may be exposed to the risk and another one might not be. So this can be things like not delivering a product. A perfect example of this is Intel, which I recently covered in a Your Stock Hour Take segment. The company could not pass its 14 nanometer node, which is just effectively how small the transistor is on a computer chip. And they couldn't do this for years. There was an operational failure. It's very well written about at this point that this is really what has pushed AMD to taking market share effectively. And the stock price has been cut in half because of this. And it's about the same point as 2015. So the last 7 years, they paid like a 2% dividend about average over time, which is obviously atrocious for the level of risk you're taking on. Who wants to get paid 2% dividend and lose half their stock price effectively over the last couple of years? Another example of this is the Boeing 737 MAX crashes, where Boeing just screwed up. They implemented poor software, and following the tragedy, they saw mass cancellations. And I don't think the sales, or they weren't allowed to even sell it until 2020 or so. And then, of course, the pandemic, then, which is a systematic risk, really screwed them over. Risk outcomes are often asymmetric, meaning that the downside event may be extremely rare, but it may be extremely impactful. So let's say there was a 0.1% chance of something bankrupting the company, taking the stock right to zero every single year. Is unlikely to happen, even if you'd have to hold the stock for 1,000 years for it to, on average, happen once. So most likely you're never going to see the risk, but it's going to be embedded in the stock price if the stock market worked efficiently, but it doesn't always. We commonly see people and investors overlook the risk of a company. So in 2021, we saw these massive growth projections. Everything needed to work out perfectly to hit these numbers. They obviously didn't. So as these operational risks really just failed. The companies weren't able to meet their goals. They weren't able to, let's say, push out 50,000 cars in a year, and they only pushed out 40,000. There's operational risk coming in and lowering the stock over time. And then, of course, at the same time, we had systematic risk. Interest rates went up. So if that same company had debt on their hands and they had floating rate debt, there's a systematic risk coming in, is pushing up their debt, which it is isolated within the company in that case, but interest rates also do affect the broad market, which I mentioned before. Everything's based off interest rates for your return. So many companies and many people overlook that, especially asymmetric risk. So we take the stairs up in price, but we'll take the elevator down. So if those risks do come to fruition, so if those one-in-a-lifetime events happen, we're going straight down. You'll see that commonly, like if you look at any long-term stock chart for any indexes, you'll see it slowly go up over time, then straight down. That's what I mean by the stairs up and the elevator down. So how do we, when we value a company, how does risk really affect it? We really need to value it at a lower multiple. Let's take Dynacor, for example, a gold processor that we've covered in many times that operates in Peru. That's compared to an identical company, exact same operations. This is hypothetical, is not realistic in that sense, but it operates in Canada, this hypothetical company. Peru just generally has a higher political risk than Canada. It has had recent protests related to their election in, I think, 2021. You can correct me if I'm wrong. And so obviously, someone who invests in Dynacor compared to this hypothetical company would want higher return because they could eventually be have the downside risk of those protests or anything else that happens in the country. So does that mean Dynacor is a bad investment? No. It just means you need to pay the appropriate price for the investment. And at other times, you'll have companies that will overestimate, the investor will overestimate the risk of a company. And that could make even Dynacor a more appealing investment because they're taking the price down because they think, oh, this risk is just massive, it's going to happen. But in reality, it's nothing. And that's one of the perhaps biggest issues with analyzing risk between a company. There's hardly a one-to-one comparison to make, and you can't really know the unknown is normally what it is. You don't know what you don't know. And that's what happens with a lot of risks. You'll hear about black swan events. No one knew about it, but it was a massive risk. So you'll commonly see analysts, they'll try to take a industry average to kind of adjust for these risks when you're trying to compare to stocks and to embed that systematic risk and then adjust for their non-systematic risks as well. So in Dynacor, let's say the average gold company was 7 PE. And then Dynacor, because it's higher risk, you only want to pay a 6 PE. Something like that. In summary, the downside risk can be sudden, and investors need to recognize risk and need to pay appropriate price for the risk that the company has.
Awesome.
Yeah, it's a good summary, and risk and time horizon are something to definitely take into account too. Like, people ask us, I have money that I need in a year from now. What stocks should I invest in? And stocks, over 1 month, 2 month, 3 month, should be considered a high risk investment, generally speaking. If you're investing 5 years, 10 years in the future, it's very appropriate to build a stock portfolio. If you need the money in a year's time, it's not appropriate to be investing in stocks. So there's a time horizon and risk as well. Makes sense. So, yeah, it's a good summary. You guys want to comment on that, or do you want to move to
one thing that I have
Brandon.
You always have you always bring up the good example for unsystematic risk or company specific risk of Elon Musk. You always say, God forbid he was to die tomorrow, the stock would likely take a big hit. So, that's
that
always
used to be true.
Less so now.
Now we're not sure.
Yes, maybe.
I literally gave a speech. I gave a speech at like a couple hundred people earlier in this year, and I was using that as an example of systematic risk. And as I was saying it, I thought, I'm not sure if it has the same effect right now as people are now, lowering their expectations or he doesn't have the cult following. He still has some of it, but it's lessened. And so the impact of that statement is lowering over time. So I kind of made a joke about it.
But it is a good example to drive that company specific risk home. That's a good one.
Yeah. if it's an entrepreneur generated company, a founder led company, and that founder is a significant part of the value that you've invested in the company, and he or she is just gone, that is risk you can't take away. Just, I talk about diversification. Like if you own 2 or 3 stocks and that's one of them, you can't account for that risk. You can start to diversify away that risk with about 20 stocks in a portfolio, right? So that's one of the ways that you can do that. That's why you can't hold 2 or 3 individual stocks. Even if you've done all the research in the world, we've done all the research in the world, you just can't get away from that fact that, that company loses its key executive, for example, and boom, you're in trouble.
Exactly. So systematic risk can be diversified away, or sorry, cannot be diversified away. Unsystematic risk can be diversified away.
CFA level
Thank
1.
God
Come
I got
on.
that. Thank God I got that.
It's true. The internet would have had a field day with you.
Oh yeah.
This one guy that's the internet would be on you.